Hello, everyone. Thank you for joining us. I've got Will here with me. We're going to walk through a question that we actually got from a client. So if you're watching this and you have questions, we would love to answer your specific questions. So don't hesitate to shoot them to us. This client asked, is there a good time to go with one company's stock? And we get asked this a decent amount. It does come up in conversation. Most of our clients know our general investment philosophy is to not go and buy individual stocks, although time to time it does happen, or in unique circumstances it does happen. But really, as many of you probably know, and certainly will, that we're a numbers don't lie type of investment policy here. So in this chart, what we're trying to illustrate here, and this is just looking at 2025. And this is all 500 companies that make up the S&P 500. So well diversified in different sectors, reasonably diversified in different sizes. Yes, they're all large cap, but some are like the ultra mega cap and some are the small end of the large cap. So a good range and a good mix of stocks. The light blue dots, is left of zero in this chart. So they had a negative rate of return. Dark blue dots had a positive rate of return. Then you can see along the bottom is the percentage in which they were positive or negative. And the other piece is on the left-hand side is the total drawdown or the largest drawdown that individual company had last year. So just for illustration purpose, I'm going to go to the far right of the graph and you'll see one single dark blue dot just shy of the 300% year-to-date total return. Fantastic. If you own that, steak dinners for sure. But if you look at the horizontal line that's associated with that one, it had a 50% drawdown at some point in time in 2025. Okay. So the point here is in order to get these excess returns, traditionally they come with excess volatility. And the easiest way to represent that, I think that I can see that from a holistic view, is to look at that orange triangle. And that orange triangle is the S&P 500 in its entirety. Okay, so the thing I'll highlight there is the vast majority of the dots, right, are north of that triangle or saw larger volatility through the year than buying the diversified basket. So that's the thing that sticks out to me the most, is just the sheer quantity of stocks that had a larger drawdown or more volatility than the S&P 500, but how relatively centered, the returns were. And these very few dots is assuming that you can kind of pick that needle in a haystack. Yeah. So what do you see when you look at this, Will?
Yeah, I love this chart. It's a lot. It's a very deep chart, right? There's a lot of information on this, but it's great information. The quote that I come back to kind of answer the initial question that was asked is there a time to invest in individual stocks? Is the quote I love. It reads, concentration builds wealth and diversification protects wealth, right? So if there is any time to invest in an individual stock, right, it is probably when you are furthest away from retirement. That comes with a lot of different factors, right? Your capacity for risk, your tolerance for risk, which this chart speaks to immensely, right? Yes, you can have 300% total returns, although that's very, very extremely rare, as you can even see by this chart. But you may be able to find one individual stock that has those type of returns. But as Sean said earlier, are you willing to hold when your position gets cut in half? Right? When you have $100,000 in one single position and you see that drop to $50,000, do you have the conviction in this company to say, no, I believe in what they're doing. I trust the leadership of this company. I'm going to hold on. I'm not going to sell. And I'm going to hopefully ride that wave back up to the top. That's really hard to do, especially in the moment. You may even think, oh, I definitely could. It could be a possibility for me. I am that convicted, until you actually see that account value drop that much. Another good quote I love is, everybody has a plan until they get punched in the mouth, right? Absolutely. And that's exactly what would happen when you see your account value fall 50%, over the course of a couple months there. So another thing that encompasses.
You know what data? Sorry. You know what? When I was listening to you, what I heard there, something that I wish we could get this data super quickly, but it wouldn't be easy. It'd be super interesting to know. Let's just continue using that 300% returner. Super interesting. Do you think that 50% drawdown came before or after the largest piece of the 300% gain?
Yeah.
And, we don't know that, but what's the probability? Like, say that it just went down 50% in the first 3 months and then rallied. You would have to have then rallied, 300% profit would be, 600%, right? The rest of that year for a total return of 300. Would you have stuck with it if for the first part of the year it was a 50% dog? Probably not. I don't want to answer for anybody, but that's just kind of what we're doing. We're making some assumptions here.
Or would you see it drop to 50, say, oh, I don't want to lose, so I'm not going to sell. You see it get back up to your original cost basis, and then you sell, right? And then you miss out on the amazing growth that's then come from that bounce back. So very, very hard to do. I do love the orange triangle in the middle there. As you can see, it's kind of further right on the chart than a lot of the dots on the chart. It's also further south, as you put it on the chart, than a lot of dots that we see there. So that is the poster child for diversification protects your wealth. And ultimately, a main job of ours is retirement planning, right? And through diversification becomes more predictable outcomes, becomes less volatility, becomes safer retirement plans, easier to plan for. So that's ultimately, to answer the question, kind of like I said before, but the original question is, if you are wanting to be super aggressive and invest in individual stocks, it's probably better to do that when you're first starting your career or midway through the career. Probably not best to start towards or in retirement.
Yeah, I had down as far as, like what other scenarios would you or could you find yourself owning a lot of one individual company? But, I also had down, you were younger, higher tolerance for risk, but maybe you work for that company, you have stock awards or stock grants, or you're just in the thick of it, building it, and that company like the back of your hand. I think that you could argue if you're a politician with insider information, maybe you buy an individual stock. Save that topic for another day. There are some circumstances in which that could come about, but I think for the average person, it's a very, very tough errand to be out there trying to buy individual stocks. It's you weren't here in our great city yet, Will, but some baseball fans, and it's the remember the 2014, 2015 Royals, right? That's the S&P 500. Get them on, get them over, get them in. Everyone loves home runs, but sometimes hitting singles and doubles is going to get you that victory as well. So I agree. We have one more slide for this topic, and this is something that I have in my office all the time. I have it laminated sitting behind me, and this is a report that comes out every year, and it shows all of the mutual funds that benchmark themselves to the S&P 500. So mutual funds are going to have portfolio managers, portfolio analysts. They're out there doing the research, interviewing CEOs and CFOs, and doing all this market analysis to determine which companies are the best and should be in our portfolio. And the reason why this is my favorite is because we'll just look at 2025 in this blue line here on the far right. This is the percentage of large cap domestic equity funds that underperformed the S&P 500, 79%. So 8 out of 10 mutual funds that benchmarked themselves to the S&P 500 underperformed it. And I looked to get an updated number before we started. The average U.S. large cap expense ratio for these mutual funds is 0.40%. So 8 out of 10 of them underperformed, and the average charged 10 times more than what you can buy the S&P 500 for. And if you just take a quick look back through history, the average here is, I'm just going to do a quick look, like it's definitely usually in the 60s. And then you do see some moments where it's might be at 50 or slightly below. there's not a single one of these. What's the lowest one? 45%. So we've never even seen a year. This is going back, 24, 25 years where even 6 out of 10 outperformed, right? But they're charging you all of this money for. So that's just kind of our general investment philosophy. And it goes back to this numbers don't lie thing. So, the way I would think about this is these large cap equity mutual funds are spending billions of dollars, tens of millions. I don't want to get carried away. Tens of millions of dollars in research, salaries, flying across the country, going to these trade shows, doing all this market research, tens of thousands of hours, man and woman hours doing this research, and they can't do it consistently with their full and undivided attention and all the resources they have to them. They still can't do it. And so when I look at us, when our primary goal is to be financial planners and advisors, investments are a piece of that. Obviously, we're not committing 40 to 60 hours a week solely to stock research, nor do we have a team doing so, let alone that and this is our career, let alone that DIY investor who's working their regular full-time job and then coming home and doing market research it's a really, really tough ask to be out there, picking stocks or getting super concentrated into one stock. So,
and that's a great point just around, what our role is in the financial advice world. It is to help clients achieve their goals, the best outcomes in the most efficient way possible. And if you look back in the data, what does the data say? That's not picking individual stocks, right? It is holding a well-diversified portfolio across different sectors of the economy and avoiding big mistakes, right? And making your entire financial life as efficient as possible to gain some tax alpha around the edges, right? Big one is just avoiding selling when things do ultimately pull back a little bit in the market. And then, the biggest one is just managing withdrawal rates of your nest egg in retirement. A lot of good information there, but overall, going back to that initial question, really in retirement is not the right time to go ahead and own individual stocks.
For sure. We've dropped a couple quotes. I'll drop one more. I remember reading about, Warren Buffett used to sell a lunch to charity. He would auction off a lunch with him to charity. And Jeff Bezos once paid for that and got that lunch and, asked him and said, good timing, I guess, for this quote. Warren Buffett just stepped down and the new guy just took over, ran his first meeting. He asked Warren, you're one of the most successful investors ever. And your strategy is relatively simple. Why wouldn't more people just follow that? And Warren says, because, no one wants to get rich slowly. And that's kind of, where our philosophy is. We're in that category of trying to get rich for sure instead of the get rich quickly type of ideas. So yeah, good stuff. I agree with you, Will. Appreciate you taking the time and chiming in there. If anybody else has any other questions, similar questions, different questions, let us know. We'd be happy to answer them. We appreciate you joining us and hope you have a great rest of your day.